morning, my name is Lina, and I'm going to share a bit about tax. I have a tiny assistant, and you can interrupt any time for questions. There are no dumb questions, some questions just have easier answers. So ask away. Andrew, it started off by mentioning that budgeting is a tool. I also want to encourage you to think about tax as being a tool. I think once you mention the word tax, people are often quite negative about it. The first thing people, whenever I mention I study tax, people say, oh, then I don't want to talk to you. And I think it's often a misconception about what tax actually is and what my responsibility is around tax. My responsibility is to be within the tax law and to pay my tax. And once that is done, my responsibility has been handled and that is done well. Whatever happens with that tax is no longer on me. I'm no longer responsible for other people's spending with my tax. My responsibility was to pay that and to be within the tax law. So I just want to mention that starting off, that tax is a tool and it is a positive thing. It can be done well. So just as an introduction, I'm going to run through the different tax types that are applicable to individuals. The first one being income tax. The rest of the session will be on income tax. So I'm not going to go into detail on that, but that is the tax that's payable by an individual on your taxable income. The second one is capital gains tax. That is also a tax that individuals can trigger when you dispose of an asset. Capital gains tax is not a separate tax. It actually forms part of income tax. So during the tax calculation, we'll look at it a bit later on. You will see exactly where it falls in customs duty. So this is not something that individuals trigger often, but it can be when you decide to import items. Then you will trigger customs duties, and that is just by the or put in place to protect the local economy. Then donations tax. So there's a threshold of 100,000 rand on a donation. So whenever amount that you receive a donation of less than 100,000, then you won't trigger that, but anything more, the donations tax of 20% will be levied on that. And also the person making the donation is responsible for paying donations tax. So if you are the receiver, then you are in a good spot. Then the next one I have on the list is estate duty. So estate duty is only levied or triggered when someone passes away and their estate is taxed. That is taxed at a flat rate of 20%. Then you also mentioned pay-as-you-earn. So pay-as-you-earn is the tax which your employer is responsible to withhold from your salary and pay that over to SARS on your behalf. So it is money that it's your money, but it's being paid over by your employer. So it's not money that ever actually comes into your account or that you are responsible to pay over. The employer is also responsible for doing that tax calculation. And then the last one I have is provisional tax. So provisional tax, I think that can often confuse people, but provisional tax is actually a wonderful system that SARS has in place when you earn income that isn't taxed directly. So that is typically anything over and above your salary. If you, for example, earn rental income, it is a good idea to register for provisional tax to ensure that during the year there are 3 provisional tax payments. There's a 2 that must be paid and a 3rd optional. To pay provisional tax on your income during the year of assessment to make sure that when it comes to year end, that all your tax has been paid and there aren't any additional and large tax payments that has to be made. I think that also starts in with budgeting. It's obviously a much better idea to pay smaller tax payments than to sit with a large lump sum payment at year end. Then I have the question to ask who should register for income tax. Oh yes, question.
Why is there donation tax?
Why is tax being levied on donation? SARS's point of view is, or how I explained to my husband once, is that SARS has a big net and that they want to catch all the money that flows to different places. So say for example you have a husband and a wife, and my husband says, but he is looking after our family, and he's going to, or he has his own business, and he's just going to give all his money to me as a donation. At the end, he's paying less and less tax because he is passing away or passing the money to someone else, but I'm sitting with all the money. So it's just to make or to put payment plans in place to make sure that as money is flowing to different spouses or companies or areas or from parents to children, that can be taxed.
So you can basically see it as income for the other person.
Yes. Yeah. Then I just asked who should register for income tax. So SARS actually asked that all people earning an income from a salary register for income tax. This does not mean that you should be paying tax. This does not mean you have to submit an income tax return every year. I think it's just from a control point of view to make sure that as money or that SARS is aware of everyone earning an income. And then it's a very simple and easy process to register for income tax. You basically need those 3 items that are listed on the screen: your ID, proof of residence, and bank statement. And it can also be done online. Then, as I mentioned, that not all taxpayers registered should actually pay tax. So who should pay income tax? This is I think, what people often want to know. Do I trigger the threshold? And the threshold is based on your age. So I have listed that on the screen what the thresholds are for someone in order to pay tax. So I'm just going to stop my timer. Then income tax is done or calculated by a very simple formula that looks like this. So you start off by your taxable income. We will look at every line item that I've listed on the screen in detail after this slide. So we start off with your taxable income. Then you take out any exempt income. You also take out any deductions or allowances. You add your taxable gain, and that equals your taxable income. Then you can go to the SARS tax tables, which list where you fall in the bracket, and calculate that back. Then SARS gives a rebate, again based on age, and that equals your tax payable. So what is considered taxable income? This is quite a broad definition which SARS gives to income. It is, most of the time, it is calculated, as I mentioned, by your employer. But examples of that would be your salary, a wage, bonus, overtime, any taxable benefits, and even certain lump sums. Then profits or losses from a trade. This can depend on what you are busy with. Perhaps you are doing investments that would qualify as a trade. Then the income from being the beneficiary of a trust. This is similar to the donations question. But if you are running money through a trust, for example, from parents to children, then the children would be taxed, or depending on certain exceptions, but then the children would be taxed on that income. So it's to make sure that income is being taxed. Then we have directors' fees, investment income. As South African residents, we are taxed on worldwide income. Therefore, any local and foreign investments is taxed. Then rental income or losses, pension income, and again capital gains. Then I have exempt income. So exempt income is income that was included in taxable income, but then taken out because it is not taxable. So the examples that I have of exempt income, all the list I mentioned are not inclusive, or that's not everything that you get, but it's just the most common ones. So the first one I have listed is local interest, and that is only to the amount of 23,800. As I mentioned, that tax is a tool. Then this can be taken as a tip, and I think Denise will also share about this later on. But if you are looking to make an investment or you're looking to make a saving, to realize that there is a limit on the local interest that you earn. So if you want to make an investment, but the interest will become more than that, then to realize that amount will be taxed. If it is less, then it can be utilized to its full amount to make use of the entire limit that you have available. Then all local dividends are also taken as exempt income. This is not because local dividends are exempt from income tax. It has already been taxed by the company and is paid out to the taxpayers as a net. So you don't have to pay further tax on it because the tax has already been deducted. Then foreign dividends, that is calculated via a formula. So these to a degree, foreign dividends are also considered exempt income. And then the tax-free investment, I think, which is a large focus point of the next session, but that is also exempt. And then any inheritance funds that you receive is exempt, and that is again because the estate duty has already been levied. So the estate of the person who passed away has already been taxed, and therefore if you earn any income from that estate, or not earn, if you receive any income from that estate, the tax has already been paid, and therefore it's no longer your responsibility, so it can be taken out as an exempt income. Yeah.
So in the previous one, you mentioned dividends as a form of tax, and here it's exempt from.
Yes. So foreign or
Yes,
local.
foreign.
Yeah, foreign dividends. So local dividends, it's included and again taken out, and the same for foreign dividends. It's only exempt to a certain, or it's calculated by way of a formula, so it's not the full amount. So a portion of it would be considered as exempt.
And one last thing, go back.
Sure.
From the investment income perspective, when does that investment income become capital gains kind of taxable?
Yeah, no problem. So the question is, when does an investment income become a taxable gain? What is the difference? So there's it should be taken on a case-by-case basis. Sorry, it should be taken on a case-by-case basis, and there are rules that SARS provides in how to determine whether something is capital gain or an income. But the general rule, or the tax principle behind it is called the fruit and the tree principle. And the tree is considered a taxable capital gain, where the fruit of it is considered an income. So, for example, if I buy houses as investment income, I buy the house, I upgrade it, and I sell it, and I do this maybe 3-4 times a year, then it can easily be considered as an investment income. Where if I do it once in every 10 years, and now I sell the house, then it's considered a capital gain. So I don't know if that explains.
I think on shares, the rule of thumb is 3 years that they work on. If it's less than 3 years, you have to give motivations, etc.
Yeah, and it's also taken on, I think if you look at the entire case of the situation, is the person, for example, unemployed and only doing foreign trading, sitting there every day doing trades, then it's taxable income. If you have a full-time salary, you're doing it every now and again, based on how markets change, then it can easily be again argued as being an investment income and not capital. Then it is capital gains and not an income under your investment income. Then I'm going to look at deductions and allowances, and I think there's often a lot of questions regarding this, because this area is where people feel they are able to take their salary and to change or to perhaps request some allowances to be worked in. So instead of having a 100 Rand salary, you would ask your employer to rather provide you with an 80 Rand salary with 10 Rand for a cell phone and 10 Rand for a car, or whatever your situation might be. But the general rule when it comes to deductions and allowances is that any allowance provided to the employee by the employer is only taxable if it is to meet personal needs. That allowance will only be deductible if it was provided to the employee to meet business needs. For example, if I have a cell phone allowance and I use my cell phone mainly for personal use, that will still remain 100% taxable in my name. If I have a cell phone allowance and I mostly use it for business calls, then only then it becomes beneficial for me to actually have that allowance. Otherwise, it remains fully taxable. Then, as my husband said, to say, for example, you want a cell phone allowance and you ask your company to take 1,000 Rand off your salary, and you take a 1,000 Rand cell phone contract, and you actually use your cell phone 90% of the time for personal use, then only 10% of that cell phone contract would be deductible from a tax point of view. So, if, in my opinion, that is not always worth your while, because you could actually just have taken a 500 Rand cell phone, you could have taken 1,000 Rand extra on your salary, and rather taken out a smaller contract to use only for personal use, if that makes sense. So the general rule is that when it comes to allowances, that expenses or amounts paid by the employer to the employee, if it is for business, if it was to meet business needs, it's exempt. If it was for personal needs, it remains fully taxable. So some examples of deductions. We will look at travel allowance again after this slide, so I'm just going to skip that one for now. But the next one is donations. So donations is a way to decrease your taxable income, but that is only to a registered PBO. It is not before you make the donation, if it is for tax purposes, it's often wise to just check whether the company is registered as a PBO to make sure that you can qualify for the allowance on the amount which you donated to that company. And it is only if the company can provide you with a Section 18 capital A tax certificate. So often you would see on company websites where they, if it's a public benefit organisation, a registered one, that they would say once a donation is made, a tax certificate can be issued. And it's very important to get that tax certificate, otherwise you would not even be able to put it into your tax return.
Sorry, Marina, I just want to pose a question that's been, it's been quite an elephant in the room, and I think if Philip maybe wants to answer that as well. A lot of people want to tithe and then ask the church for the Section 18A.
We've explored every element around that.
I must honestly say, I think it comes back to what you said earlier. It comes back to where your heart is now, you're stewarding. But for me, I think that must be over and above. I don't personally think we should contact the church and ask for Section 18A. I don't know what's your view on that, Philip, but
the answer is really simple. So African tax law explicitly prohibits 18A for religious purposes.
Exactly.
So we would love to, but we can't.
Yeah.
I think that answer or that question probably comes up quite often.
That's it. Yeah, I've seen it a lot.
We are a public benefit organisation exempt from tax, so people are able to give donations. The donation that you make to church doesn't count towards your 100,000 Rand a year annual limit. You can do that, but you can't deduct you can't use it as a deduction on your taxable income, which would be amazing if it could, but tax law doesn't allow us to do that.
Unfortunately, it's just, I see it as a rule. It's quite black and white to me.
Yeah.
It's a rule.
Yeah.
Any funds donated to a church aren't allowed under Section Capital A. Full stop.
You're a cheerful giver.
I'm a cheerful giver.
Yeah.
Exactly. Yeah. So unfortunately, churches aren't able to provide those certificates. It would have been wonderful. Then the next one is medical expenses. So the whole medical aid tax credit system was revised just a few short years ago, with the main intention of it being to make it more fair towards everyone. So the general rule again when it comes to medical aid expenses is if you earn a very high salary, then your chance of actually qualifying for a medical aid expense is much smaller. So the medical aid deduction is for people who earn very small salaries with high medical expenses. They would typically qualify quite easily for a large medical aid tax credit. Also, the person paying the medical aid or the person paying the medical expenses is the only person that can apply for this exemption. So for me, I'm only part of I am on my husband's medical aid, therefore I cannot include anything on medical expenses on my income tax return. It's only for the person paying that or the main member of the medical aid. Because there's that scale of how it works, it is often a good idea or something to explore for the person, if you are a married couple, for the person earning the smaller salary to rather have the medical aid on that person's name, because they are earning a smaller salary and you have perhaps a large family, you have more medical expenses, the chances of qualifying for a medical aid tax credit is a bit higher. So that's just something that everyone can look at, but I know often companies ask the employee to be part of the medical aid. So that can be a limit to it, but if it is something that is possible, there's an opportunity for a saving or an opportunity to pay less tax or to at least get the deduction. And then I have retirement funds, so this is any contributions towards a pension provident or retirement annuity fund that is also allowed as a deduction. Again, all these deductions have limits on them, so it's not as simple and as easy to say that in order to pay less tax, make a larger contribution to or take out a retirement annuity fund. It really depends on your income, your situation, and what product you currently have. Then just looking at travel allowance. So travel allowance, if you earn travel allowance, this is only if your company gives you a travel allowance to either buy a car or you have a company car. Then any allowance in this regard must be based on actual kilometers. And I missed the beginning part of Philip's introduction, but what we spoke about previously was that as Christians, we want to be wise with what we have, and we want to be good stewards with what we have been given. And to be lacking in admin and to pay more tax would not be doing that. That would be, I think we would be wasting what we have been given just because we are lazy in admin. And that's not, in my opinion, a wise way to calculate and to do tax. Tax is a tool, so if you just keep accurate track of your actual kilometers, then you can have, or you can earn a lot of, or you can get a big tax saving if you do it, if you qualify for it. And it's a basic thing to keep track of. So it's, as I mentioned, it's only based on actual kilometers, and therefore you must keep very accurate track of it. The first one, or SARS requests a logbook, which should be submitted with your tax return, and the items which is required to be on the logbook is the odometer reading on the first year of assessment, on the first day of the year of assessment. So an individual's tax year starts on the 1st of March every year and runs to the last day in February. So the meter reading on your car must be taken on the first and the last day. And then whenever you travel for business, the details of those trips must also be included. Then there is a logbook which SARS has available on their website for download. So if you do earn a travel allowance and you are not sure, there's even quite fancy things that you can plug into your car or before you start the trip, you can actually just note whether it's business or travel, business or private. It has the address, so there are a lot of tools on the market available to help taxpayers to keep accurate track of this. And then in recent years, I think it was from last year, SARS actually requires a lot of detail when it comes to the actual reason for the trip. So just simply stating meeting or supplier or client is not sufficient anymore. So it must contain quite a lot of detail. They are very strict when it comes to this, because there are large savings available for taxpayers through earned travel allowances. And then this is often a question that is asked, so I just included that, but traveling from your house to your office is not considered a business trip, that's considered a personal trip. However, if you travel from your house to a client directly via your house to a client and then to the office, then it can be considered as a business trip. So that should just be noted, and I think also considered on a case-by-case basis. And then I'm no longer working as a tax practitioner, so I just spoke to a colleague in the week, and she mentioned that these days, or one of the items that you need in order to claim travel allowance is the cost price of your vehicle. And SARS actually, she mentioned that SARS specifically requests the actual invoice that you got when you purchased your vehicle. So that's something that should also be checked from a personal point of view, as SARS requests this quite easily. Yeah.
So travel allowances in the time where Uber and Bolt arrive and software, can those other means of transportation count towards travel allowance?
Not that I'm aware of. Sorry, the question was whether Train or Uber is available. So travel allowance gets complex quite quickly. So it basically splits into 4 legs. It's either a company provided vehicle, it's a company provided vehicle which you actually buy from the company, it's your own vehicle, or it is allowance or claim back. So you just mentioned that during this month I travelled X, Y, and Z, and this was my fuel card, or they pay whatever, $250 per kilometre, and then they pay that out to you. So as far as I know, it's not applicable to any means of transport that isn't either a allowance to a motor car or a company provided vehicle.
Although something like Uber or Gautrain would be able, depending on your if you're earning income as an entrepreneur, that could go through as an expense, or if you're earning commission income, then that could be part of your deductible expenses. It won't qualify under the travel allowance section, but you will be able to deduct it as income earning expense.
I think what Rina said earlier, it's very important, is the fact that there's a value onto the vehicle, what you purchased the vehicle for, and that becomes your variable element that they use when they calculate the cost implication of the travel allowance. So if you don't have an invoice for your vehicle, it'll be difficult on the tables to actually get that fixed amount.
Yeah, and what Philip mentioned as well now is that the majority of this is applicable to people earning a salary. The moment you are a commission earner, then things changes up quite a bit. Then there are more expenses available to commission earners because they often work from home. So it's easier for a commission earner to claim back a portion of their house, for example, under a home office, as a deduction, where it's not that easy for a salary earner to deduct amounts like that. Then just looking at capital gains. So that, as I mentioned, it forms part of income tax on the sale of an asset. A disposal, I just asked what is a disposal. People often think a disposal is just a sale, but it can be a donation, so if you gave something away. Then to calculate capital gains, the formula is very basic and simple, and the formula is proceeds less base cost equal taxable or capital gain. Proceeds is mostly the amount which you earn for the sale of that asset, and base cost is often what you paid for the asset. But as a tip, the base cost can often be increased by multiple items, and therefore if you are in a situation where you are selling a capital asset, it is very wise and in your best interest to keep very close track and proof of any expenses that you incurred that can be added to the base cost. So for example, if you are selling a flat which you bought as an investment, or it used to be your primary residence and now you are selling it, items that can be added to the base cost. So the base cost would predominantly be the price that you paid for that asset, but items that can be added to it are any improvements, any legal fees or service fees which you incurred in order to sell that asset. For example, you had an estate agent come to value your property. That cost which you paid to the estate agent can be added to your base cost. And obviously, looking at the formula, the higher your base cost, the smaller your capital gain. So it is when you are in the position of selling a capital asset, there's a very easy and basic guide on the SARS website. It's called an interpretation note, and it says, I think it's called like the ABCs of capital gains tax. And under that, there's a very detailed explanation of and examples of items that can be added to the base cost. So it would be a good idea to look at that and to keep record of that as you are busy, for example, renovating or busy with capital assets. Then there's an annual exclusion of 40,000 Rand for an individual. So only if the capital gain portion is higher than 40,000 Rand, then that would actually form part of your income tax. Anything smaller than that is not attract any tax. And then there's a primary residence exclusion of 2 million Rand. So it's actually quite unlikely that you trigger capital gains tax on the sale of a primary residence, because the capital gain, the actual gain portion, must be higher than 2 million Rand. So that is SARS's way of allowing taxpayers to obviously sell their primary residence without triggering tax. And then there's also an inclusion rate of 40%. So if, as I said, the formula is quite simple. It says process less base cost equal capital gain, but then on that capital gain there's an exclusion of 40,000 Rand, and then there's an inclusion rate. So the actual tax rate for capital gain assets are quite small, and it's not an item that is taxed on a very high scale. Sorry, just to jump back to the larger scale calculation. So we've looked at taxable income, that was mostly remuneration or bonuses, salaries, examples. Then exempt income was mostly investment income, if you remember. Deductions and allowances was travel, medical aid, any amounts paid to your to any retirement funds, and then added your taxable capital gain. Then if you look at your taxable, and that equals your taxable income. From there on, once you've determined your taxable income, then you can only jump to the tax tables. So people have often said they get their payslip and they want to calculate how SARS calculated that pay you earn, where you see where it's not that simple, because as I mentioned in the formula, there's lots of items that are first deducted, and only then you go to the tax tables. So I've just listed the tax table on the screen to show the percentages which you are taxed at, and we will do an example of that now on a very basic calc. Then all taxpayers qualify for tax rebates. So this is once the tax has been calculated, an amount that is deducted from the actual tax. I don't know why it's there. I feel the tax tables could be this, but this is the amount, and it's based on age.
That's there so that it's a simple way of making a tax threshold. So our tax threshold at the moment is roughly 80,000. So that's just built in so that your first 80,000 is effectively tax-free. That's what the rebate does.
So that's the rebates that are deducted from tax. And then I have a very basic tax calculation just to show how those tables work. So this taxpayer only earns a salary of 20,000 Rand per month, and the taxpayer is below the age of 65. So you have to work on a yearly basis, so you multiply by 12 to get to your gross salary for the year. And then if you go back to the tax tables, you would see that this person would fall into the second tax bracket, and that 37 is the basic, or is the flat rate of tax that is already applicable, and then any amount over and above the 205,900 is taxed at a rate of 26%. So I've just done the calculation there to show you how it is calculated, but it is quite basic and simple to work out. Something that I want to mention is this is never the responsibility of a taxpayer. So this is calculated by your employer, and where your pay you earn is deducted. So if you don't understand this formula, or you are unsure or scared that you would miss something, this is not something that you need to worry about, as it is already calculated by your employer. The pay you earn is deducted from your salary. It's just to show how that pay you earn is actually calculated. Then after, it adds up to about 2,500 Rand tax per month, and you take that obviously off your salary, and that will give you 17,000 Rand almost as a take-home pay. Then this can be a pitfall if you earn income from multiple sources. I think people are often worried about them being pushed into a higher tax bracket, because of income from different sources, and that is definitely a reality. So the example that I have on screen is just to show the effect of how easily that is achieved. For example, this person earns 2 salaries, one of 15,000 Rand a month and another one of 8,000 Rand a month. Multiply both by 12, and in each or by each company, the taxpayer only falls into the lowest tax bracket. So that income is only taxed at 18%. Each company withholding that pay as you earn is not aware of your second income or your second salary, and therefore they are also not responsible for asking you whether you perhaps have additional income. So they are only responsible for the amount that they pay you and withholding the correct pay as you earn of that amount. So in this instance, company A would withhold 18,000 Rand tax for the year, and company B would withhold 3,000 Rand. So your total tax for the year on 2 salaries would be those two added together of 21. But as SARS sees all your income as being provided from one source, one taxpayer, it's regarded as, or all of it should be added together. And therefore, if you add it together, it would put you into the second tax bracket, where you are no longer only taxed at 18%, but at 26%. And then the tax adds up to being 41,000 Rand, and you only paid 21. So it would give you a shortfall of 20,000 Rand, which is not a very nice surprise to realize only at tax year end. And I think this is where provisional tax comes in. And also to mention that SARS is very strict when it comes to underpayments, because remember that pay as you earn that is being paid over to SARS on a monthly basis is their money. And once they have not earned it and they've been without it for 12 months, they want interest on it, and they will issue or levy a penalty because you did not or pay the money to them on time. So, for example, on an underpayment of 20,000 Rand, that could easily be pushed up to almost 25,000 Rand, just looking at interest and or underpayment penalties and interest being levied on those amounts. And so, sorry, I wanted to say still was that provisional tax is a place where provisional tax comes in. Provisional tax, as I mentioned, is not a separate type of tax, but it's just a system which allows you to make smaller payments to SARS in order to avoid surprises like this. I think people often also want to know when you should employ someone to do tax on your behalf. And if you are in a situation where you are earning income from more than one sources, and this can also be investment income, if you have a large investment portfolio, then you would, or it's worth your while to actually do the calculation, even if it's a basic calc, to see whether it would perhaps push you into a second tax bracket, and to then register as a provisional taxpayer. SARS also levies penalties on if you declare, say for example you are registered as a provisional taxpayer and you just declare zero return, you don't have to pay any provisional tax, and it comes to year end and now you have underpaid and you have to pay in. They also levy penalties on that because you registered and mentioned that you have additional income. It's also important to note that the onus of tax remains always on the taxpayer. Therefore, even though the company is withholding the pay as you earn on your behalf, the onus will always be on the individual, and to do your homework on that. So another option, if you do not want to register for provisional tax, or if it was just a second job for a certain season or term, then you can also consult one of the employers and mention the second income to them, and then additional pay as you earn can be withheld from your salary. So there are options available if you earn income from more than one sources. Then I want to talk about submitting your income tax return. So this is a very simple process, and I think SARS tries to make it as easy as possible for all taxpayers to be compliant when it comes to submitting income tax returns. So it's done by e-filing. If you don't have access to a computer, you can do it at a SARS branch, but it's quite easy to do it online. Tax season starts on the 1st of July every year. So as I mentioned earlier, your year of assessment ends at the end of February, and then there is time for the company and companies, for example, medical aid, which you contributed to issue you with all your tax documents or your SARS source documents. And this is normally issued then from March until June. And then when the 1st of July comes, tax season opens, and then you are able to submit your income tax return. So all companies are also responsible for submitting your information to SARS. For example, your employer submits your earnings to SARS via an IR-defined. The medical aid companies, they also submit those data to SARS. All the banks, investments, all that information is submitted to SARS. So SARS actually has the information, and you submitting it allows them to make sure, or to enable them to check that everything has been disclosed. And then the tax season ends on the last working day in November. It's always such a rush, those last few days of November, but it really doesn't have to be. It's so simple and easy to do it. And I always encourage people to do it on the first day of the tax season, because then it's done. And it really it doesn't take that long. I mentioned that the sales documents are submitted to SARS by companies. When opening your tax return, the majority of the information of your earnings, your investment income, your medical aid expenses should already actually be on the system, and you can compare it against the documents which you received from your various companies. And then once the tax return has been submitted, SARS issues an assessment. The assessment just confirms the net result of the calculation. So this would either be a refund due to you, or money that has been paid into SARS, or it can be a zero. So that's, for example, 0.07. It's very seldomly that it just adds up to a zero. Then the assessment also confirms whether the tax return has been selected for verification. I think people often think that they are being audited by SARS if the tax return is being selected for verification, where it is definitely not the case. When you are being audited, it's quite a serious process that only occurs after all the checks of verification has been handled, and SARS still feels that there might be information that you are not providing them. So the process of verification is quite simple. SARS just asks for the source documents which you use to complete your return. It is really not a serious process. You upload those documents, and then SARS just compares that you included everything that you had to your disposal on the return. This would mostly happen only if there is a refund due to you. Most often when you have to pay money in, SARS would never ask for, except if it's a very large amount, they wouldn't often select the return for verification. It's mostly when there's a refund due. And then it's important to note that any refunds will be withheld until the verification process has been finalized. So for a taxpayer who sees that they had a large travel allowance and they kept accurate track of all their tax records, they are due a refund of 10,000 rand. SARS will withhold that 10,000 rand refund until the verification process has been finalized. And there are timelines on all these things. So for example, the document should be uploaded within 30 days as an example. And that's just something that I also feel as Christians and as people who want to steward their finances well, is to when there are deadlines or timelines to finish the process, to upload the documents as soon as possible, to get it done, and not to drag on that. The next slide as well, which is tax on rental income and cryptocurrency. So rental income is considered a trade, and that is also then taxable, but there are multiple items which can be deducted from your rental income before the actual rental income amount is taxable. Again, that should be tracked quite accurately. So it's rates and expenses. This is not all. And then interest on bond, which is a very large portion of the amount that is deducted. It's not the bond portion. If you bought the house, the first few years you only pay on the interest on bond, and only then you start paying the bond, the actual bond amount. So the interest on bond can be deducted from your rental income on a pro rata basis. Or if you, for example, rent your own house, then we calculate via square meter which percentage is considered as a trade and which is personal use. Personal use will never be deductible. So interest on bond, advertisement, estate agent fees, and then repairs. So repairs would be if you restore something to its previous condition. Where improvement would be if you better what for example, the floors, you changed the floors and you made it better, then it's considered an improvement. Where if it broke and you restored it, then it's considered a repair. Repairs can be deducted from the rental income, where the improvement can be added to the base cost later on and then deducted as part of capital gains. So both those you would get your money back. And then I just said income from cryptocurrency can be taxed either as an income or capital gains, depending on how you trade. Yes. Are there any other questions?
So the expenses that are permissible are deducted from the rental income, not the rest.
No, or is this when you are just renting?
So let's say I have a rental property.
Yes.
Yeah, and I'm renting it out to someone.
Yes.
Yes. So will those expenses be deducted from my rental income?
Yes. Yes.
So then, taking that into consideration, now it goes under the impression that you have some trouble going to pay for it as quickly as possible.
Yes.
If the interest on the bond can be deducted,
yes.
Is it then ideal to have a longer bond period?
Yes. Yes, it's a wise way. SARS allows a loss on a rental property for 5 years before they start asking serious questions, because the reason for you also having rental income is most probably as an investment. So no person would buy a property, rent it out at a loss, and deduct money from SARS every year. So they allow a loss for more or less 5 years, where you can explain, or your reasoning could be that you have a large interest on bond, or you only started renting it out now and therefore you incurred a loss. But after 5 years it gets a bit more sticky to explain why you are still making a loss. But yes, what people then often do is they buy another property and do the same, or extend the bond to ensure that they still make a loss. But there are ways to do that, but 5 years is the general rule. Any other? Yeah.
I have two questions. The first one is, if you only earn income from one source, do you have to submit and file the income tax return, even if you're already paying the fee?
It depends on what the income is. So there is a threshold on that. I would have to check the exact amount for you. But there are, I think if the income, looking under correction, but I think if it is less than 500,000 rand only from one source, the pay you earn has been deducted, then there's no obligation on the taxpayer to actually submit an income tax return. Obviously, if you have additional expenses that you want to claim or that your employer isn't aware of, then it is in your best interest to still submit the return. But if it's as simple as one income from one employer below that amount, I have to double check what the amount is, then there's no obligation on you to submit the return.
And what if you're working from home? Because nowadays with COVID, many people are working from home. Can you claim the home office under the income tax return?
Yes. Yeah, so that comes up as a question quite often. So she just asks whether your home office is allowed as a deduction. So how it used to work previously was that an allowance can only be claimed by the taxpayer if it is actually provided by your employer. So I can't say I use my cell phone for business, and now I want to claim that as an allowance, it should be provided by the employer as a breakdown as part of your salary. So your salary is not only salary, it's both salary and cell phone allowance or travel allowance, and home expenses used to qualify under that as well. So it used to be home or salary, and then also home office expenses. And if there wasn't a home office expense on your IRT5 or in your employment contract, then that would not have been allowed as a deduction. Where now SARS, I actually have a slide prepared on that. So that I think there's clarity required on that by SARS. It's not been decided in final. As I spoke to colleagues during the week in preparation of that, they mentioned that there is still clarity being or requested from SARS on this. So the current publication seems as though anyone and everyone who work from home are able to claim a portion of their house where they worked as a home office expense. So the only question and clarity which we require is whether SARS still needs the employer to state that you were allowed to work from home. So whether that be in an employment contract or in a letter confirming that to the client. But then yes, so there are three, or the current publication that is out says that the room must be exclusively and regularly used for you to work from home. So if it's not a certain sit-out area, if you just work from your kitchen counter, then that it would be hard to argue where if you had a small study and you only sat there and you spent, I think it says more than 50% of your work from that area, then it is possible to claim that, and then that is also done on a pro rata basis, based on square meterage of your house and the area which is used, and then the following types of expenses can be deducted as part of your home office expenses. So that would again be interest on bond, water, electricity, rates and taxes, cleaning, insurance, any levies, repairs and maintenance, security, and internet. And I think a lot of taxpayers would actually want to make use of this deduction because most people would be able to benefit from it.
Rita, an important note that they've also added is you have to work 6 months continuously from home. Can't be 3 months, then a month from back to the office, and then 2 months back home, month back to the office. It must be 6 months continuously.
Yeah, and something as well is that this is mostly applicable to salary earners. So again, if you are a commission earner, it needs to look a little bit different.
Sorry, I just checked. It is 500,000 for e-filing.
Yeah. Okay, so if your total income then is less than 500,000 and it's only from one employer, you are not required to submit an income tax return per year, yeah, for that. Yeah.
I also have another question regarding the provisional tax. If you're earning a salary and you're already paying on it, and then you have a business and you're also earning a salary from it, and you also pay on it, you still have to register as a provisional tax?
No, not necessarily. The provisional tax is mostly it's to protect the taxpayer, so it's to avoid you not having any surprises. So I think the only instance in that situation where it would be beneficial for you to register as a provisional taxpayer would be when you when both those incomes put you, for example, into the 18% tax bracket, but actually both incomes added together would put you in another tax bracket. Then it might be a good idea to actually register for provisional tax to make sure that there's not an underpayment. Does that answer your question?
But the business would need to register for provisional tax.
No, the individual.
She says she's earning income from one source, and then the second business, which I've heard you correctly, is your business.
Which is drawing a salary from.
Which you're also drawing a salary from. So for the salary purpose, you wouldn't have to because you pay as you earn is being deducted. But that second business would be registered for provisional tax because the business is also a taxable entity.
Do you have to register for provisional tax even if you are not having a proper income?
Does every business have to register for provisional tax?
No. No, it depends on what business. Because if it's a company is again taxed at company tax of 28%. So no, they don't. No, it's not a requirement of every business.
Okay, there are some thresholds. It's probably worthwhile just having a look as to what those thresholds would be.
Yes. But if the company is paying out the salary to you,
But it's her company, so she owns both.
yes. But then it's worth paying out a large salary, or it depends on what the salary is. So it has to be considered on a case-by-case basis, because the company is taxed at 28%, where the salary will be taxed depending on which bracket it falls into. So if you are not making a very large profit, then it's better to pay all of that out to yourself as a salary, tax it in a very low bracket, for example the 18% tax bracket, and then you don't have any income to declare under your company tax, and you are being taxed in the smallest bracket on a personal income tax.
So such note says all companies have to register for they're automatically registered for. They don't even have to do it separately.
The problem is when you want to try and do an investment or do anything in the business and you don't have a tax number, they're not going to allow you these days.
Yeah.
And I think that's where the interpretation comes in.
Now, I think the last question is regarding the pay and the UIF.
Sorry, your pay you earn.
Yes, the pay as you earn and the UIF.
Yes.
That as an employer, that does not have to pay the pay because the employee earn less than the threshold.
Yes.
Do you have to register to pay the UIF on a separate bracket?
Sorry, I just want to make sure that I understand your question correctly. So you are asking are you asking from a company's point of view? So if the company is paying a salary to an employee, and you are asking whether UIF should also be deducted from that employee's salary.
Yes. And the salary does not really fall under the threshold. For example, it's less than 80,000 per year.
Okay. So
the company does not have to register
as
for the payee.
Yes.
So does it have to register for the UIF?
UIF is the requirements for UIF, I think, is based on the number of hours that you work at the company. So it depends on how many hours you put in, and that is where the requirement for UIF registration is required.
It was 24 hours last time I checked.
24 hours per month. I think the requirement is, perhaps Philip can double check, but I think the requirement is 24 hours, if it's more than 24 hours a week. Talking under correction, does anyone know the exact number of hours? I think it's 24 hours a week. Then you are required to register for UIF as an employee. Yeah. If you have an employee working for you, and that employee is working more than 24 hours during a week.
Month.
Is it a month? 24 hours a month.
Yeah.
Then you are required to register as a UI or for UIF, and then obviously withhold or deduct and pay over.
Can you do that yourself without paying the payee?
Can you register for UIF without registering for pay to earn? Yes, it's two separate companies. So UIF is done by the Department of Labour, where pay to earn is handled by SARS. So yes, for example, if you think about, the lady helping me at home, my domestic, she's not registered for tax, and I don't withhold pay to earn from her salary, but she does work in more than 24 hours a month for me. So UIF is withheld, and that registration is done without the pay as you earn element. Any other questions? Investments. Yeah.